Great. In today's section, we're going to look out for the other aspect of leases. Then we move on quickly. Now, with the leases, especially to calculate for the interest charge of the finance cost, there are two ways of determining the finance cost. So the finance cost or finance charge in leases, IFRS 16. The finance charge probably in leases bracket IFRS what 16. Now there are two ways that we can get a financial. You have the actual method, the one that we know, the one that we can calculate using percentage. That is the actual method. That is the actual method. Perfect. That is okay. So the finance charge can be determined in two ways. The first one, we call it the actual method. Actual method into brackets using the percentage, the one that we know. So far, all the examples we solved is under actual method. You can also have what we call sum of years digit. Sum of years digit. So I'll pick one question right away. We'll solve it under the actual method. Finish, solve it under sum of years digit. And that is the end of the section. Then we go to sale and leaseback transaction. How to treat sale and leaseback transaction. That is all. Okay, so let's pick our first question or illustration. Okay, so let's see this question. Third call acquire an item of land and a lease. On April 1st, 2017, the present value of the future lease payment and the current amount of the right of use was estimated to be 15.46 million. And 3 rental payments of 6 million per annum are due to be paid in arrears on 31st March each year. The useful life of the plant is deemed to have 5 years. There was no option to buy the asset at the end of the lease term. The interest rate implicit on the lease is 8%. Perfect. Okay, due to the time, I'll quickly look at the sum of year digits, how we will calculate the sum of year digits. So using sum of year digits, how are you going to calculate? That means when I do that, you have to look for the actual method. Actual method is the normal one that we know, using the percentage to calculate the finance charge. In this section, I am just going to determine the finance charge, both. Okay. All right, I will provide it a little, but I'll be fast in here. Let's see. So if I'm using the actuaries method, meaning the normal one, I'll set it on like this. First, what goes to P&L? Year 1, year 2, year 3. Second, what goes to the financial position? So year 1, year 2, year 3. This is the workings. First, First, depreciation. The first work is to determine the right of use, which is same as the present value of the minimum lease payment. So checking the present value from this particular question, as I said, the present value of the future lease payment and the current amount of right of use is $15. So it has been calculated already. So there's no need for us to find it again. It has been calculated. So go straight forward and then use it in. Good. So you get something like depreciation will be but let's raise thousands of dollars here. It's in thousands. So to be 15,000. Depreciation be the right of use or the cost of right of use divided by the shorter of the lease term and then the asset useful life. So select the shorter. So here we're going to use the lease term, which is 3 years. So amount to be 15,462. 15,462 divided by 3. Any answer that you get, kindly key it in. What level is the finance cost? We can calculate it. Then you go to the financial position, record right of use. Right of use. You record the current amount in, and I believe strongly current amount, you can easily determine it. Then you go to non-current liability. The must be lease obligation. You go to your current liability, the must be lease obligation. So basically, this will be the items. I'll quickly perform the entries in here for us to see how best we can calculate. So first, study loan. This is arrears. So in arrears, first of all, we are going to calculate what we call movement in liability. Movement in liability. So first, we put a year here. We tell the examiner balance brought down liability at the start of the year. Interest or the finance charge. Yes, 8%. This is actuaries method. You get the total amount or sub total. Then you get a rental payment or lease payment. Then you get a closing balance. That is how we are going to look at for year 1, year 2, year 3. So for year 1, the balance, in fact, present value of the lease payment is the same as the cost of the right of use. So here will be 15,462. 462. Then we look at for our finance charge. That will be 8% on this. So that examiner 15,462 times .08. Let's say 1, 2, 3, 4. 1, 2, 3, 7. 1, 2, 3, 7. Add it back. So plus 15,462. You get 16,699. Average. So 16,699. 699. Okay. 699. Then the lease payment, let's go and pick the lease payment from the question. The lease payment is in arrears 6 million, so that will be 6,000, right? So kindly put the 6,000 in here in brackets. Throughout all the years, it should be 6,000. So the same figure throughout, the same figure throughout. I'll write it. Then when I take it off 6,000 from this. You should give me 10,699. I'll push the 10,000 here, 699, and I'll strike 8% on it. So times 8%. Okay, so that's 6.23 times 0.08. So I get 8. But I get something like 856. 856, right? 856. Okay. So it's 856. You add it back. So add it to 10,699. You get something like 11,555. So 11,555. Okay. So we take off 6,000 from it. So that's 555,555. I like that. The fives are plenty. 555. Another 5. Again, you see the 5 here. And last year, don't worry yourself to calculate any percentage. 8555555. That's another 5 again. The interest, don't worry, the figure over here should be 6,000. So find the difference between 5555 and then 6,000. The closing balance should be 0. So therefore, the difference between this should give us 445, right? The difference should give us 445. Agreed. So 5555 less 6,000. So 445. Good. Now we are done. Let's go. So the finance charge for the year 1 will be, this is the finance charge. So easy to be determined. 1, 2, 3, 7. Yes, 8, 5, 6. And then 4, 4, 5. Agreed. Let's go to the financial position in the balance sheet. How do you record the lease liability or the right of use, non-current liability, lease obligation, current liability, lease obligation. So we said that this particular figure, 10,699, becomes the total liability at the end of the first year. We need to break this into two, current and non-current. Sorry, that's why it's not coming clear. Current and non-current. To get a non-current one, go to the next year, the balance left after the last repayment, that becomes the non-current liability. So this is the balance. This is the next year, the balance left is 555. So here non-current liability becomes 555. Then the difference between that figure and 10,699 becomes the current liability. So the difference between this and this becomes the current liability. That will give us, so let's see something in here. So 5,144. So that will be 5,144. Let's go to year 2. Year 2 is the total liability. Go to the next year, the balance left after the last repayment, this one is 0. So no non-current liability, 0. So that means the 555 there becomes what? The current liability. So here 0 and 0. That is all. So this is the end for the actual method, meaning that the actual method uses percentage to calculate the interest. We have what we call sum of year delegates. So let's quickly go through sum of year delegates. Yes, and again. When you're going to use the sum of year delegates, that one we don't use percentage to obtain this interest. This interest, you're not going to use percentage to obtain it. So the sum of year delegates goes like this. Let's quickly go to the sum of year delegates. Now let's see how best we can look at the sum of year delegates. So the sum of year delegates are there. Okay. So here, we're looking for sum of year delegates. Sum of year delegates. That one to still, we need our P&L. Year 1, year 2, year 3. It does not change the format. So our financial position. Now, what will change? Year depreciation don't change. Finance costs still the same. Everything here is still the same. Year 1, year 2, year 3 still the same. What will change is the calculation of the interest. So first, you need to calculate the interest. So first of all, let's go and calculate the interest. So calculation of the finance charge. Finance charge. So all what we have to do is group them, start the year, right here debit, and right here the finance charge. So the year 1, 2, and 3. Good. Now, right at the start of year 1, how many years left? Left 3 years. If I just turn the numbers upside down, or swap them, or dislocate them, 3, 2, 1. Meaning that at the start of year 1, it left 3 years. At the start of year 2, it left 2 years. At the start of year 3, it left 1 year. Get the total delegates. Put all the delegates together. You get 6, right? Good. When you're done, calculate what we call total interest. Let's calculate the total interest. Total interest. In fact, that is what's supposed to calculate first before this one. How do you get the total interest? It's equal to the cash price of the item, the difference between the cash price and the total payment. So tell the examiner total payment under the lease. So total lease payment less the cash price less the cash price. Here we assume the cash price as the present value of the minimum lease payment. So the total amount here will be, so let's put 3 zeros in here. Now we are paying 6 million every year. So it will be 6 million times 3. That should give us 18,000, right? 18,000. But actually, what's the present value? What's the fair value or the present value of this? So the present value happens to be 15,642. 15,642. The present value that we use. So let's do that one. 15,642. So when we go to the question, yes, 15,462. Perfect. So what's the total interest? The total interest will be the difference. That should give us 18,000 plus 15642. Now, if there's any initial deposit, can I add to the total payment if there's any initial deposit? So there's a question that I'll probably hand over to you. There will be initial deposit. So this one, we call it total interest. Meaning, if you should have money today, you are going to pay 15,000, not the 18,000 now we are paying. So the total interest is 2,358. So 2,358 is the total interest. So come and then apportion it here. So for year one, the finance cost will be the decades left times the total interest all over the entire decade. So it will be 3 out of 6 times this figure, 2,358. That will be the finance charge. Over here will be 2 out of 6 times 2,358. That will be the finance charge. Over here to be 1 out of 6 times 2,358. That will be the finance charge. So let's get this answer correct. So here one will be 101,179. So $1,179. And then year two will be 786. So 786. And year three will be 393. Okay, so basically that is the interest. Then you proceed to calculate the movement in liability. This section you will do it for me. So let me take it off for now. Right after the calculation, you are going to do it for me. So still movement in liability. The movement in liability, you need to still set a tone. We're in arrears, so yeah. But if I don't squeeze it, no go there. So yeah. But that's what you can see. Okay, so year 1, year 2, year 3, and then liability at the start of the year, the interest, then the subtotal, lease payment, and then the closing balance. This is arrears. If it's an advance, can you take notes? Advance, yes, you know the format already from the previous calculations. Okay, so liability at the start will be 15,462. The interest, you can record the interest. Interest for year 1 is 1179. So the total. The lease payment part, interest for year 2, just record them 786,393. So that's the figure that you are going to study to what the financial position, sorry, the P&L as the finance side. That's the interest. Yeah, even there's 8% finance cost in the question. Don't use it when you're using what you call the sum of year delegates. The moment you type the 8%, meaning you're using what you call the actual method. Perfect. So if they don't specify which of the methods you use, can you use the normal one that you know? That is the actual method by using the percentage to calculate for the interest. Let them ask you before you use the sum of your delegates. Thank you. So add it to this. So you get 16,641. 16,641. And you paid 6,000, right? Okay, so when you take it off get 10,641. Put the payment in brackets. Shift it here, 10,641. The interest will increase it. So kindly add. Get 11,427. You take our 6,000 from it. Get 5,427. You come here, 5,427. We add this, you get 6,000 exactly. And you take 6,000 from it, you get 0. Always closing balance should be 0. When you add it to this, you might get 6,000 exactly. And then you continue with the game. You continue with that of splitting into two. That of the current liability and non-current liability. You continue using this, and then you move on with the game. On that note, I'm done with some of the certificates. I have to also give you some of the questions to try. Yes. So I'll upload some questions for you to try them. Great. The last year she gets 0. If you're not getting 0, meaning it means that this cash price was not the actual cash price. Let me calculate the cash price and see if it will be 15,604, 2,000. So kindly find the present value of 6,000 payable in per year for 3 years. So find an annuity factor. Let's just find the present value of the item. If we are paying 6,000, what will be the annuity factor? 1 minus bracket 1 plus 0.08 to the power minus 3, all divided by 0.08. Okay, so you get 2.577. Okay, now times the 6,000. It should give us the cash price of this item. Times the 6,000. It is different from the one given to us in the question, that is the cost. So if it's different, 2.577. 2.577 times 6,000. 1, 2, 3. Perfect. Everything which is the same as the one given to us in the question, right? Then it's not, this figure should be 0. There's an issue here. In fact, this is given at 15,642, meaning that's the same as the one that they give us in the question. The challenge is when you subtract, you not get 2358. No. The issue is the total interest here is not true. This figure is not true. Can you confirm it again? It's not true. Because that figure, I'm getting 2538. So it should be 2538. 2538. So if you use the 2538 to give you the answer exact, so let's kindly use that one and see. It should be 2538. Agreed. I hope you agree to it. Let's quickly confirm something. Now, what happened is this: we have they changed some of the figures from the original question. Now, going to the original question, the figure is 15,462. So 15,462. In our calculation, we made 15,642. So, causing the difference. It's 15,462. Agreed. Good. So 462, not the 642 that we use there. That's what causing the difference. If you find the difference between that figure, it's the same as the difference between this and this, like what we are getting. So quickly, when you do that, you get 538. Like if you use the right figure, divided by 2 will give us 1,269. Over here, if I should go through the right figures, it will be 2538, not 2358. How we get it if we use the right figures? Good. So here should be 462, but not the one that we quoted. So let me make the changes and let's get the correct figures right away. So 2538. Can you get me the answer? 2538. So let's see 2538. Okay. So year one should be 1269. And then year two should be 846. Yeah. And finally you get something like 423. Okay. Now when you come here, it will change these figures slightly. It will change this one too. And then the rest will still be the same. So let's quickly adjust it and move on. It's 1269. When you add all, you get, and it's 846, 423. So the first year, when you add, what you get? So let's come here to our year's calculation. So 16,731. Then we take 6,000 from it. Taking 6,000 from it, I'll get 10,731. Push it here, 10,731 to be. Then we add 846 to it. Then get something like, then we add 846 to it. 11,577. So 11,577. You take 6,000 from it. Get 5,577. Now, if you are getting 5,000, so come here, 5,577. Add this one to it, what do you get? Now add a 423 to the 5,077. And then you get exact 6,000, right? Perfect. So that is how we are going to look for. So kindly take notes, which the rest of the calculation continues from there. Okay, now you are taking this particular question. You are using both methods, actual method and some of your decades. So you are looking at this. Okay, so here they're saying that on 1st of October 2003, First Cocoa acquired an item of plant under a 5-year lease agreement. The lease requires an immediate deposit of 2 million with 5 payments of 6 million paid annually in arrears commencing a year by this time. The present value of the future lease payment was 22,746,000. So over here, they've given us the present value. They've calculated it already. So that is all. So we continue. Now to get a total cash price is equal to the present value. That is all. And then to get a total payment, kindly add the immediate deposit plus the rental payment or the lease payment. The lease payment will be 6 million by 6 by 5. So 6 million by 5, that would be 30 million plus the 2 million, so making 32 million. So that's the total payment. You take off the present value from it, then you get the total interest. Good. So that is the question. Okay, so now let's talk something more about the sale and leaseback transaction before we end today's edition. Today is a very short discussion. Don't forget to try your own though. Yes. So sale and lease back. Fine, basically, there are two sections. There are two sections that we need to know. Sale and lease back transaction. Here, the leasee will first of all sell the item to a buyer, then immediately lease it back from the buyer. Good. So basically, there are two types of this transaction, and then each will have for different accounting entry. So I'll go through some few or solve just a question to explain this. In fact, in the subsequent section, I will actually take them one after the other and lay out the procedure, how according to IFRS 16, how we should account for this. Basically, let's see something here. So still a leaseback transaction basically have to do with the leasee. So if an entity, the seller or the leasee, transfers an asset to another entity, let's say the buyer or the lessor, and then leases that asset, the same asset, back from the buyer. Good. How do you account for it? You can get it from the paragraph 98 of the IFRS 16. Good. So basically, there are two types where the transfer of the asset constitutes a sale under IFRS 15 revenue. So where the transfer of the asset is a sale. So there are two sections where the transfer of the asset is a sale, and where the transfer is not a sale, does not constitute a sale. And so where the transfer of the asset is not a sale. So take note, anytime the sale leases back, either the transfer will constitute a sale or the transfer will not be a sale. How do you know? Here we need to identify, we need to use the requirements set up in IFRS 15. IFRS 15 revenue. Now revenue gives us the condition that need to be satisfied before we can record revenue. So we should take note. Okay. So in the subsequent ones, I'll probably lay down the procedure given to us by the IFRS 15 on how we should account for if it is a sale, it's not a sale. I'll give you a small transfer is a sale if and only if it is under operating lease. If that's sale, if the lease was under operating lease. So if you lease it under operating lease, then it constitutes a sale. Then that means there's a sale. Yeah, you know, operating lease, you lose control. Operating lease, originally you owe the assets and you dispose it to B, and then you lease it back under operating lease, meaning that control is gone. So there's no, but if you lease it under finance lease, then it does not constitute what? A sale. So finance lease. This is the simplest way to identify whether this sale, whether this transfer is a sale or it is not a sale. That is all. That is all. Now, currently, there is a revision going on at this area. So very soon we'll come out with a revised treatment with the sale and lease back transaction. So basically, let's see the common treatment. We'll go through the common treatment. Now, I'll pick a person where the transfer is what? A sale. Look at how best we can treat that one. But kindly watch out for a detailed video on the treatment stipulated by the IFRS 16. I think we do have 4 steps. If the transfer is a sale, 4 steps that need to be followed. But if the transfer is not a sale, that one just a substance of a form. Here, just convert it. The asset will be transferred from the current value to that of the present value of the minimum lease payments. So here, if it's under finance lease, that means you are the owner. Finance lease gives you the accounting right to be the owner of the assets. How we get it? So if it's under finance lease, you are the owner. So you have disposed something, and now you are the owner of that item. How can it happen that you've made a sale, you sold something to someone, at the same time you are the owner of it? It can't happen. So here we are saying that it's not a sale. What happened that way? There's no sale. So don't record a sale under IFRS 15. So that is all. Now, if the transfer constitutes a sale, 2 things will happen. I'll give you some few guidance before we move on. So let's pick the one that the transfer constitutes a sale. If the transfer is a sale, you kindly take note of the following. 2 things will happen. First, all what you have to do is this. Calculate the profits. Calculate the profits. So step 1, determine the profit. So the profit on sale. The profit is equal to, normally there are 2 instances here where the sales is at the fair value and the sale is not at the fair value. I'm taking the position where the sale is not equal to the fair value. Good. If the sale is equal to fair value, it does not pose a tough challenge. The profit is equal to that of the fair value. So the profit should be equal to the fair value less the carrying amount at the date of what? The sale. So profits that should be recorded. Number two, if the sale value or the selling price, if the sales value is not equal to the fair value at this date, then we have what you call tentative gain. Tentative gain, that means the company will earn what you call tentative gain. And that gain needs to be amortized on the lease period. Tentative gain. Basically, that is it. Basically. So here, if the sales value is not equal to the fair value, any excess needs to be amortized for the lease period. So here, amortize any excess amount. So excess amount into bracket the sale value over the lease over the fair value. So excess amount, in fact, let me make it clear for you. For the excess amount, we are talking about the difference. Excess amount. Now let me calculate the excess amount for you. It's equal to how much is on the item, the sales itself, the sales value minus what? The fair value. That becomes the amortize this answer, we call it tentative gain or notional gain. So you amortize the any excess amount that is sales minus the fair value over the lease term. Over the lease term. That is all. And it goes to your financial position. It goes to your financial position. And every year, if I look on the deferred profits, every year a portion will be released to the income statement. Every year, a portion will be released to the P&L. That is all. So every year, release a portion to your profit and loss. And that is all. Again, the asset will be removed from the entities list. So number three, the asset needs to be what? Removed. So perform the, I would normally call it the rituals. So by taking the carrying amount from the entire carrying amount of the class of that asset, and then the accumulated depreciation from accumulated depreciation, and then you move on. So on this one, I'll pick a particular question and then solve that question which you will explain. Was I'll be coming out with a detailed procedure from the IFRS 16. So the IFRS 16, right? So let's quickly read this particular question. Look at it. I like the question so much. Call it Techiman Limited. That is corporate reporting ICAJ November 2020 exam question. Let's go. It said, advise the directors of the entity of the correct accounting treatment of the above transaction IFRS 16 as information permits. Meaning that as information permits. So as the information that we have. Yeah. For the year ended 1st December 2019. Okay. So basically, let's see. Techiman Limited sold one of its warehouse on July 2019 to a finance house and leased it back under an operating lease. On the same date, the current amount of the warehouse on July 1st, 2019 was 16 million. The terms of the sale and leaseback were as follows. Sale proceeds, 23.5 million. So that's the sale amount. So confirm this, check this. If it's equal to the fair value, if it's equal to the fair value, there's no hala. Now we move on. But if it's not equal to the fair value and this sale is above the fair value, that means the entity has made what you call notional gain or notional profit or a tentative profit. This profit, we call it deferred income or deferred profit. It must be deferred into the future because until the lease is over, you cannot tell yourself that make that money. You've made the money to the tune of the fair value at the date of what? The sale. Okay, let's see. And half yearly lease rental payment. Half what? Yearly lease rental payment of 1 million paid in arrears on 31st December and 30th June over 4 years. The open market value, that's fair value. The open market value of the property would have been 20 million if not leased on these terms. So that's fair value of the asset. Fine. The lease rental payments will approximately double the market rate for such lease. Fine. The finance house can terminate the lease at any time without month notice to the Techiman, at which point any excess of the sale proceeds over the market value of property not yet repaid becomes repayable immediately. So that is why we are saying that you cannot take records of the excess of the fair value. Yeah, because you've not made any sale. You've not made that profit. We will calculate it, then you see. Techiman depreciate. So Techiman depreciated the property up to 1st July 2019. Perfect one, yes. Then de-recognize it. Yes, that's good news. Recognizing a profit of 7.5 million netted against expenses in the statement of profit and loss. No, this profit we will calculate and see. If we calculate this profit and it's not the same, it's not in line with this, we need to reverse it. So take note of what we are going to do now. The first 1 million Ghana Cedi 6 monthly lease rental payment made on 31st December 2019 has been charged to the cost of sales fine. No other accounting entries have been made. The Techiman now wishes to amortize the excess of the sale proceeds over the market value on straight line basis over the period the warehouse. The warehouse will be used for 4 years. So in this case, first of all, get the actual profit that needs to be recorded by the Techiman. Tell the examiner is a fair value less the current amount. What's the fair value? 20 million. Fair value is 20 million. What's the current amount? 16 million. So the actual profit should be what? 20 minus the 16 million. The actual profit should be, let's set the entries. So actual profit. So in the books of the Techiman. So actual profit. I'll calculate this as what? Which is equal to the fair value. So actual profit. So entries that need to be made. Actual profit, fair value range, right? So let's say 20,000. it should be 20,000. And then the current amount at that date happens to be 16,000. So therefore, the actual profit should be what? 4,000. Okay. So it will be 20. So what again? Okay, so let's see the still amount. It was sold for 23.5 million. So therefore, we need to amortize the excess of this over the fair value. So 20 versus the 23.5, the excess. So third examiner, deferred profit. So the part that need to be deferred is equal to, so deferred profit should be is the excess of the proceeds. So the proceeds, that's the sale amount, which is 23,500 minus the fair value, less the fair value. The fair value right here happens to be fair value happens to be 20,000. So therefore, the defensive gain or the notional profit happens to be 3,500. This one is not realized until the asset is moved from our balance sheet, or until like the lease period is over. So deferred, and this should be amortized over 4-year period. Every year, a portion should be released to the income statement. Now, you know what they've done? They have calculated the profit using the 16 versus the 23. So they calculated the profit as this. They calculated the profit as the proceeds less the carrying amount by adding these two together as what? Profit, 7,500. So they've recorded profit of 7,500. First and third examiner, it might be reversed. Yes, that profit is recorded, we should reverse it. So you need to reverse that profit. That's the first thing that we need to do. So that profit needs to be what? Reversed. So the profits need to be reversed immediately. So in short, they have recorded 7,500. So I need to reverse to the tune of what? To the tune of here. They have recorded this. So I can reverse the 3,500 from it because the 3,500 need not to be recorded there. It needs to be amortized. It needs to be amortized. Or I'll set a tone, I'll set a solution from the entry requirement. Good. In fact, these figures should be on the balance sheet. It should be on their balance sheet, meaning that representing a deferred income. So first, I need to take the 7,500 from the profit. So take it from their P&L. So 7,500 need to be what? Credited to the P&L. So they have credited it, right? So I have to debit it by taking it off. And then credit other income of 4,000, and then credit deferred income of what? The 3,500. And that is all. So let's say the entries. So the entries will look like this. First, so these are the entries. Number one, we are reversing the excess. So P&L, I'll debit P&L. with what 7,500 because they have recorded this 7,500 profit is wrong. And then when I do that, immediately I will credit the P&L with the right figure of what 4,000, right? But the right profit should be 4,000, not the 7,000 you're talking about. And again, I'll credit. In fact, here I need to provide names. So here, reversing what they've done, reversing their profits, and then I'll credit the P&L back with the actual profit by 4,000 cities. Actual profit is 4,000 cities. Agreed. Good. So actual profit 4,000 cities. Again, I'll credit my statement of financial position, my balance sheet, financial position. I'll call it deferred profit. Let's call it deferred profit. It has a credit balance. I'll credit with what? 3,500. That is the initial entry. Again, I have to amortize this figure over the lease term. Now, in short term, if we are debiting P&L 7,500 at the same time crediting P&L 4,000, so the same as we debiting P&L with what 3,500, the next effect. Then amortize this. What's the lease term? 4 years. Kindly divide each one by 4. And every year, a portion should be released to the income statement. So release the first portion for me, let's see. Every year, a portion should be released to the income statement. So what will be the first amount being released to the P&L? When we check, the lease term is 4 years. Good. So for 4 years, 3,500 divided by what? 4. And now that one goes to the income statement. But don't forget that this year we only have 6 months to the year end. So we only have what 6 months to the year end. So we need to take half of that figure. Because July, we are preparing the account as at 31st December 2019. But this transaction took place 1st July 2019. So we need to take account of what 6 months. So we need to release. So meaning that again, let me clean here and do it. Turn down the entry. So final year amortized. So we are going to amortize the excess profits. So let's call it deferred income. Now we take it from deferred income. So first, but we are going to transfer to the P&L. So debit your deferred income or deferred profits. So debit deferred profit or income. Into bracket, do the calculation. Is a 3,500 divided by 4. This 1 year times 6 out of 12. And now give us 6 out of 12. That should give us 438, right? To the nearest whole number. 438, agreed. Or 437.5. So 438. So I'm just assuming that it's 438. So meaning that I'm reporting in thousands. So take note of that. So 438,000 need to be released from this balance. And And again, credit your P&L, credit your P&L. And the P&L, it goes to other income. All the P&L section going to other income. The same 438. That is all. We are done for this particular question. Thank you very much for coming. Now, next meeting, we'll look at for complex situation. And then I'll give you the breakdown or the sets, the standard steps required by the IFRS 16 to go by the transaction when there's a sale. But when there's no sale, for that one is not other difficult. Where there's no sale, just an examiner that where there's no sale. Where there's no sale, if the transfer does not satisfy the requirement under the IFRS 15, the seller continues to recognize the transferred asset and transfer the proceeds and treated it as what financial liability. And here you can use what you call IFRS 9 to account for it. The financial liability. Good. And then the transaction is more in nature like a secured loan. That is all. The secured loan. That is under the sale and lease back and a finance lease. So that one is substance over form. So that one, in that case, it is not a sale. It's the same as you giving out your assets for or as a collateral for a facility. Good, how we get it? Perfect. So why the sale is not, sorry, why the transfer is not a sale, just an examiner that this one, the person transferred the asset continue to record the assets and treat the proceeds as a what? As a liability. Take note of that. So where the transfer is not a sale, the one that transferred the asset continues to record it in his book as an asset, and then record the proceeds, the amount received as what? As a liability, financial liability. And you can account for it using IFRS 9, financial instruments. That is all. Unfortunately for us, this is how far the good Lord will bring us. If you do have any question, kindly ask before we end the game.